Good morning. Good morning, everyone. Welcome to our 6th annual Fintech Conference organized by the Federal Reserve Bank of Philadelphia and our conference partners, Columbia University, the Wharton School, U of Cambridge, the Bank Policy Institute, and the Brookings Institution. It is wonderful to see you all in person after quite a few years of virtual conferences. And we are super happy to report that several hundred people are also watching us online. In fact, almost just under 1,000 people signed up for this event. Now, on behalf of the organizing committee, I would like to thank all of you for taking the time out of your busy schedule to be with us. Now, we're going to get started soon, but just a quick housekeeping announcement. You see QR codes at the entrance and the information desk. That will take you to the conference booklet, which we don't print the booklet this year. That has all the conference agenda and speakers' bios and headshots in there. And just also, when we do Q&A, just want to let you know that we will start with questions from the auditorium first, and then if we have more time, we would take questions from WebEx, but continue putting your questions in the WebEx chat box. And for the auditorium, please wait for the microphone before you start speaking. All right, so now we're gonna get started, and I am honored to introduce the President and CEO of the Federal Reserve Bank of Philadelphia, Patrick Harker. He has been in this role since July 2015, has been about 7 years. And unlike the other Fed presidents, President Harker is an engineer by training. He got his PhD in engineering from UPenn and then became the dean of the Wharton School and president of the U of Delaware. Now, because of his unique experience and background, he is particularly very interested in fintech. In fact, he wrote a fintech paper 25 years ago in the 1990s when he was a professor at the Wharton School. So now with his unique set of expertise, it's quite natural for him to deeply appreciate the potential role that fintech could play in moving us closer to a more inclusive financial system. And if you are interested to know what he likes to do in his spare time, he likes to transform, I know a lot more attention to this part, he likes to transform unfinished piece of wood into something nicer, better, bigger, like a bedroom set. He creates new things all the time, new innovations, and happy to report that he still has all his fingers. And here is President Patrick Harker.
And yes, I do have all my fingers there, it's proof. So really, good morning. I'd like to begin by just giving a big welcome to everybody here in Philadelphia and to all of you who are joining us virtually today. Now, one of the benefits of hosting a hybrid conference like this is that we derive the advantages of being together, but there's also the beauty that we also can bring people from outside who won't have the opportunity and typically don't have the opportunity to be here physically. So I think this is a nice marriage of these two worlds. So again, for those of you online, welcome. For those of you here in the auditorium, welcome. So it's great to have such a large turnout here today. And I think that's a growing testament, not only to the growing interest in the subject we're here to discuss, fintech, but also to the stellar lineup that we've assembled for the Philadelphia Fed's 6th annual Fintech Conference. And my colleague, Jalapa, I can't say enough about your ability to organize these meetings. You've done it again. Year after year, you keep raising the bar. So if you've never been to one of our FinTech conferences before, trust me, you are in for a treat. Over the next 2 days, you will hear from the leading voices in industry, the government, and the Fed. And speaking of the Fed, here is where I have to give my standard Fed disclaimer. So the views I'm about to express are my own and do not necessarily reflect those of anyone else in the Federal Reserve System or on the Federal Open Market Committee. So let's go back. At our last FinTech conference, it was in November 2021, and although that wasn't even a year ago, if you think about it, I think it's safe to say that conditions for the FinTech industry, not only to also to speak of the broader economy, have changed quite dramatically. I'll give one example. Last November, I spoke about the rapid growth of buy now, pay later firms, which effectively repurposed Kmart's old layaway model for the digital age. With buy now, pay later, shoppers are able to divide payments for purchases into a series of installments, sometimes with zero interest tacked on. And even better than layaway was, consumers also get the product up front and then pay for it, of course, over time. This has proven to be a very popular option, with buy now, pay later representing $2 of every $100 spent on e-commerce last year. Buy now, pay later looked robust in a low interest rate environment. That's because the vast majority of firms in the space have no deposits to tap. Instead, they borrow money that they typically turn around and lend. Typically, their revenue comes from fees charged to merchants. Rising rates have drastically changed the landscape for buy now, pay later. Now forced to borrow at higher rates, these firms are facing pressures they simply weren't facing last November. Unsurprisingly, major operators in the space have retrenched, with one of the leading lenders shedding 10% of its workforce last month. The fintech landscape is changing rapidly as a result of macroeconomic conditions. Significant developments are occurring, and we're lucky to have so many superb panelists here this week at this conference to discuss them. The adoption of buy now, pay later has important implications for offering financial services to low and moderate income consumers or others who may be locked out of more traditional means of obtaining credit. So consider a young adult in her first job who has no established credit history and therefore can't get approved for a bank credit card. She can now use buy now, pay later to finance that important purchase. Moreover, some buy now, pay later lenders report payment histories to credit bureaus, allowing these new borrowers to begin to build a credit history. Or think about the family that has declared bankruptcy several years ago and that continues to be charged high rates on traditional forms of lending, even though they're back on their financial feet. Buy now, pay later offers an alternative method of accessing credit. So a survey of buy now, pay later users in the United States from the Philadelphia Fed, our survey, found that users are generally lower earning, younger, and more likely to be non-white than users of other methods of payment like debit and credit cards. FinTech, in other words, can help foster financial inclusion. That's undeniable, but that's far from inevitable. Like all tools, FinTech can be used for good, ill, or somewhere in the middle. Just as FinTech can foster frictionless legitimate transactions, for instance, it can also foster frictionless fraudulent transactions as well. Fraud is an example of where a little bit of friction can be a good thing. FinTech has developed a lot over the 6 years we've been hosting these conferences. And the discussions like those we will have over the next 2 days have moved out of the largely theoretical and ever more into the realm of the empirical. We have increasingly rich data sets here in the United States and abroad that provide important insights on how FinTech is reshaping credit markets. So let's take one example. A recent paper examined how FinTech lending differed from traditional bank lending in China during the beginning of the COVID-19 crisis. Analyzing the dispersal of unsecured personal loans by 3 large fintechs and a large commercial bank, the researchers found that fintechs were more likely than banks to extend credit to new and financially constrained borrowers. Fintech borrowers were more likely to be unemployed, to earn lower incomes, and to have had prior delinquencies. A happy story, right? Well, not quite. That's because it turns out that the delinquency rate of fintech loans tripled after the COVID-19 outbreak, whereas there was no significant change in the delinquency rate for bank loans over the same period. Now, to me, this is a puzzling finding, somehow suggesting that, at least in this case, fintech lenders were unable to accurately predict borrowers' financial health in the event of a pandemic, but commercial banks were. That strongly implies that Chinese fintech firms were operating with imperfect or insufficient information about their borrowers. Now, while issuing credit to the financially constrained is potentially beneficial, it does no good to the lender or the borrower if the loans end up delinquent. But this is hardly an iron law. Other examples have found fintech loans going delinquent at lower rates than bank loans. That suggests that elevated or lower credit risk is not necessarily inherent to fintech itself. It's not inherent to fintech, but dependent on each firm's particular business model. Another recent paper that examines unsecured small business loans in India offers an important example. There, the authors found when fintechs used a more holistic method for evaluating borrowers' credit risk than a simple credit score, both borrowers and lenders benefited. Over several years, Indian small businesses seeking credit from fintechs agreed to share data on their so-called cashless payments, certified checks, internet banking, mobile banking, point-of-sales transaction, and money transfers on mobile apps. The upshot? They gained access to larger loans at lower rates than those who use traditional credit scores to access credit. So one can imagine such a model working here in the U.S., where the credit constrained are able to demonstrate their credit worthiness in ways besides their credit score. So in my opinion, there is no good reason that on-time rent or utility payments should not be just as determinative in obtaining credit as on-time payments for car loans or credit cards. Again, the opportunities to use fintech to reach the economically constrained and financially marginalized are truly exciting and, I think, very important. It's now on all of us to seize them. So again, thank you so much for joining us. We have a rich menu of programming over the next 2 days, and I'm sure we're all going to benefit from being together. So let me now turn it over to David Mills, my colleague from the Board of Governors, who will lead a discussion on the future of payments. David?